Hello, Keith. Welcome. Welcome to the ByteTree webinar. It's great to
Hey,
see you.
hey, Charlie, thanks for having me.
Where are you calling from?
Phoenix, Arizona.
Yeah, how hot is it outside?
You know, it's getting a bit cooler, but still probably hitting 40 degrees centigrade, and we have a bit of humidity this time of year because of our monsoon season, so not especially pleasant.
Well, we're well into the autumn, and it's a very unusual autumn over here because the grass has started growing, having been dead all summer. So it's a bit of a strange one. But the difference, I think, between Arizona and where I'm calling from in the UK is that there's not a single animal within 100 yards that can kill me. I bet you there are lots of animals near you that can kill you.
Not too many in the desert. The coyotes, maybe in a pack. Usually they're afraid of people. They get small children or pets. But you go up into the mountains, you can get mountain lions. I definitely wouldn't want to tangle with one of those.
That sounds pretty scary. Well, look, talking of living in the mountains and all the rest of it, we're going to talk about gold mainly today, but our thesis of our webinar is gold and Bitcoin. And but I think that you're probably much more interested in gold than you are in Bitcoin. In fact, you're quite cynical about Bitcoin. So I'm just going to kick off with one question. It's actually 6 questions, but think of it as one question. So I want your 1, 10, and 100 year price target for gold and Bitcoin. Could be very approximate, could be much higher, much lower, $0, $1 billion, whatever. But just to get us a framework of what you're thinking. So 1, 10, and 100 year view on gold and Bitcoin.
I think it is extremely likely the price of gold will be higher than 1,700 US dollars in a year. 10 years, it starts to become what in the software world we would call a race condition between the utter failure and collapse of the dollar, at which point there won't be a dollar price of gold anymore, because just as there isn't a Zimbabwe dollar price of gold anymore. At 100 years, there's no question in my mind that we're into some other monetary regime and we won't have dollars to price gold in. Or there may be something they call dollar, but it'll be, like every once in a while, Chevy comes out with a new car and they call it whatever, but what is it, Dodge? They're getting rid of the Challenger and the Charger because of the emissions and electric vehicle mandates. So they're going to have an electric, Challenger. So they'll call it the same name, but it won't be the same, the same thing.
I think I've nailed it, Keith, with my opening question, because I think we've set the scene of where this conversation is going to go with, given your 10-year outlook review, which the 100 outlook obviously follows from there. Okay, very quickly on Bitcoin, 1, 10, and 100.
I would say on Bitcoin, I have no idea where the price is going to be tomorrow, let alone a year. I'm not sure anybody else does either, but I certainly don't. Longer term, the challenge I have with Bitcoin is its value is set exclusively by the marginal speculator. So do the speculators get tired of it? Does it continue to go in some sort of trend? Obviously, for the past, well, not year, but I guess 10 months, it's been a downtrend. Today below $20,000 again. I don't know what to read into that, if anything, but longer term, it's a speculator's game. It isn't money, it doesn't work as money. It isn't even really currency. When people say, oh, I paid for my latte with it, not exactly. The Starbucks, whoever it is, has to be paid in dollars. So they set a price in dollars, and then they hire a third-party currency exchange via an API, who then finds a fourth party who has dollars and wants to buy Bitcoin, and then they wash this through this complex multi-party swap. So the Starbucks gets the dollars, the guy with the dollars gets the Bitcoin paying customer gets the coffee, and the exchange gets a fee. That doesn't really work for those things, but people are very excited about it right now.
Well, I obviously am very, very closely aligned with you on the gold side. Bit of disagreement on the Bitcoin side, but I do agree it's a speculative asset. It's definitely going down in the last year, and it's. I suppose what I would say about Bitcoin is it always leads the rally. So when the world gets better, it tends to be in front. So the question, I suppose, is in the next 1, 10, 100 years. I was wondering whether you were going to say 0 because you think Bitcoin is totally flawed, which is fine. That's a clear answer. Or whether you just sort of, better than the stock market, worse worse than the stock market, or in the monetary camp with gold? Clearly, you don't think it's in the monetary camp with gold, but would you be erring towards zero or somewhere near the stock market return?
So yeah, in the shorter term, and obviously, past performance, no predictor future performance. It's been a high beta, version of the Nasdaq or the Russell 2000 or something. Longer term, the problem from a systemic point of view, it's a negative sum game. I mean, every penny that anybody makes on it is because the next person buying in, but the network itself takes tens of millions of dollars a day just to run it, which is also taking those dollars that are coming in. And does that become unsustainable at some point? How does that work? As the miners, block reward is decreasing, does that change the incentives in a way that fundamentally alters it? These are questions I don't have the answers for. It wouldn't surprise me if it was zero, but it wouldn't surprise me if it was $1 million.
You're asking all the right questions. Anyway, definitely fees become 100% of the action over the years. And so that is a big question of how they'll be. But let's get back to gold, because that's where you've got fascinating things to say, where I think that in Bitcoin, this is going to turn into a negative spiral. We'll come back to Bitcoin. Let's do the fun stuff first. So we'll start with an interesting gold chart, which no one can disagree with. That gold just goes up, doesn't it? That's pretty much every major currency in the world. And in Turkey, it's gone up a hell of a lot in the last 5 years. And people talk about gold like it's some kind of underperforming, lagging, failing inflation hedge. And I just find that strange, where this is actually what's happened. It's kind of up.
Well, I was going to say, of course, gold is subject to drawdowns along the way. It's not a monotonic up. There's, I mean, even in the Turkish lira, that's an interesting chart. What is that? Just before the midpoint of 2021, there's a big drawdown from what is that, 650 to 475. I'm just guessing on your almost vertically down.
This is a rebased 100 scale, so it's not the exchange rate. But
I see. Yeah. So it has these drawdowns along the way. As far as inflation hedge, I think it's a perfect inflation hedge, provided one can separate out, which is very hard to do, the component when prices rise. Let's say prices go up 100% over some period of time. Some component of that 100% is due to non-monetary forces. So in the UK, I've written about this a number of times. They passed two stupid laws pre-COVID. I want to say in the 2017 to 2018 range, but don't quote me on that. One of the stupid laws said you're prohibited from domestic fracking for natural gas, which basically shuts down all domestic production of natural gas. The other forces forced all of the heavy industry and power plants who formerly used to use coal and oil to switch to natural gas, which under the other laws now not producible domestically. Okay, those two laws are bad in and of themselves. Synergistically, of course, the effect of, it's not 1 + 1 = 2, it's 1 + 1 = 3.5 or something. Then you have the COVID lockdown, and then the what I call the whiplash from unlock, and suddenly it's impossible to ship Christmas tree ornaments from China to LA, let alone ship natural gas around the world. And suddenly there's a real shortage. Price of natural gas in the UK goes up 10x or something like that. That's not a monetary phenomenon. Now, of course, energy being built into everything from food to transportation of goods to manufacture of most goods, that is going to have a big impact on prices of almost everything. And one should not expect the price of gold to go up commensurately, because that's not a monetary force. That's the government passed some stupid laws that made things genuinely scarcer. Reduced supply equals higher prices. Yeah. Whereas when the dollar or the pound is debased, then gold is the perfect both measure of that and hedge for that.
You bring up the first really strong point, that the inflation that we've seen we've seen different types over the last couple of years. In fact, there are lots of different types. And monetary debasement is the one that you think is the trigger for a gold bull market, and I totally agree with you. And we've had some of that. We'll come to my model in a sec, and then we're going to go to your model. But first, I want to fly through some big charts that we want to talk through about about where gold is in the world right now. Gold S&P ratio. The S&P, of course, is stronger than the most international markets because of the tech effect, which has just been enormous this cycle. And so, you kind of think that if you looked at that in a normal market like Europe or Japan or some more emerging markets, actually gold is outperforming those markets already. It's just, kind of more neutral against the S&P because of the tech effect. And it's almost like those big tech stocks have taken the role of gold this cycle, because they've got a bit of a cash flow, they've got a bit of growth, and they're seen as rock solid, and they're COVID proof, and they're Putin proof, and we all need them, and they're pro lockdown and pro green and ESG, all of these things. And so you kind of think that there has been a lot of people saying, well, just own these facts because they do the job of gold. What do you think of that?
Well, I don't think it's the job of gold. I mean, every company is subject to the risk of either the market conditions change. Great example of that is COVID and the lockdown. There were X number of companies that thought they were doing really, really good, and all of a sudden, what was it, March 12, this year in Arizona, the government comes along with this big dinosaur foot, goes, and there are companies that suddenly were doing better. Right now, I believe we're on Zoom. So Zoom was really boosted by what the government did, but there were plenty of other companies that wouldn't want to be in the restaurant management business, for example, right about March of 2020. And so you have the risk of external market changes. You have the risk of internal market changes. One of your competitors does something disruptive that kind of obviates the need for you and your company anymore. Microsoft builds your functionality into a free thing. So Zoom is facing competition from Teams and from the Google suite, both of which are basically free or close to free, or people are paying for it anyway. My company, we use Teams, but
coming back to gold or the S&P, I mean, over the last 50 years, why do you think that it went, gold beat the stock market in the 70s, lagged in the 80s, 90s, beat in the 10s, then lagged, then led again? Well, what do you think are the big forces there?
So I would invert it and say, I think you get a clearer picture when you say, what if you priced all these equities in gold? Right. And so instead of saying gold is outperforming them, let's eliminate the dollar from the equation and say, how do these things measure up when measured in gold? And then you have a bear market. Well, you have a bear market because companies are doing shit.
Flip it around and you got yourself a valuation indicator, as it were. Is that what you're suggesting?
I'm saying use gold as the numeraire for valuing things. So through the 1970s, you have rising interest rates, and as every finance student should know, net present value of future earnings goes down as interest rates rise. So not only was that a difficult period of time, rapidly rising input, costs and so forth for companies, the bigger problem is even if they kept that same dollar of earnings, or even if that dollar of earnings went to $2 worth of earnings, the discounting of the higher interest rate meant that all the future earnings were worth less today than they were, yesterday. And so you just see equities not performing very well until we get to 1981. And it's interesting, it's almost monotonically down, that ratio, which means stock price is almost monotonically up, starting around 1980 or 1981, which is when the interest rate begins to fall. So equities become worth more and more and more. Happy good times, everybody feels good. They feel that, the confusion of a boom versus, a healthy economy, which nobody in those days was really thinking about. And, you get to 2001 before next crisis.
So Keith, I mean, so what you're saying is that this is if you did this over 1,000 years, which obviously we don't have an S&P 500 over 1,000 years, but if we did, are you saying this is a mean reverting relationship?
Not entirely. I'm saying that it's an interest rate sensitive relationship. So as interest rates are going up, equity values, whether measured in dollars or gold, are going down, and as interest rates are falling, equity valuations are rising. I mean, what's the present value of $1 to be paid 1 year from today? Well, it's $1 minus whatever the interest rate is. So if the interest rate's 10%, which was higher than that in the 1970s, but if the interest rate's 10%, $1 to be paid a year from today is worth 90 cents today. So you have what's the present value of something that pays out $1 every year from now to infinity? Well, it's $1 plus 90 cents plus 81 cents plus 72 cents, dot, dot, dot. Mathematics says we know what the value of that is. That's $10 is the net present value. If we cut the interest rate to $5, no other change, the same dollar of earning every year, but at a 5% interest rate, that thing's worth $20. 2.5% interest rate, that thing is worth $40, and so on and so forth. So you see this huge trend because the interest rate's falling.
Keith, the bad news is we're coming on to interest rates. So I'm going to try. We're coming on to interest rates. I think my job today is to try and keep you on the slide as best we can. So if we could try and do that, we are going to cover interest rates, but we're going to go to inflation next because it's very topical, and we've had numbers out, UK and US yesterday. But before we go there, I just want to touch on the everything bubble, right? So this chart, let me explain what it is. It's the S&P 500 divided by the price of a 30-year bond, a 30-year perpetual bond. So basically, if the yield of that bond is very high, it's like 20%, then the price is about, under 2. And if the yield is 0, then the price of that bond is 100. And so it's a very simple way of looking at the price performance of equities against bonds over a decent period of time. Now, there's a small lie in this chart because I've hidden the 70s. The 70s, this chart goes straight up because equities do massively outperform bonds in a high inflationary environment. But they only did that after the 1974 crash. So equities have to be cheap. Equities aren't a hedge against inflation until they're cheap, which is why in places like Turkey, you have 4 times earnings. And it's it's in low inflation countries, you have much higher multiples on the stock market. But right. the bottom line is today we've got this massive stretch, the biggest stretch I've ever found in the history of US equities of a bond of equities relative to bonds. And I don't know if you want to comment. Maybe it's not your thing, but this is sort of setting up to sort of demonstrate how abnormal the times we're living in are. And so every time the bond market goes down, i.e. the yield goes up from here, it's stretching that relationship more and more and more. And of course, that was a setup for the 87 crash in a very small way.
This is a little bit outside my wheelhouse, but my initial take on this, I see, on Twitter every day, people post all sorts of interesting graphs. And a lot of times, I just want to comment and say, that's just tell rubbish, that the graph is either, chart crime or otherwise misleading. This one, I think, is pretty straightforward, and it makes sense. And it makes a very compelling case that unless interest rates are about to reverse, which is now more of a political question, as when will the Fed, do that, and what are the political forces that are pushing Jay Powell in both directions right now? But unless they're about to reverse, this chart suggests that equities are way overpriced, and that they have a very far way that they could fall. One of the interesting things about markets, when something gets, I kind of think of it as, imagine you have 2 steel pins and a rubber band stretched between, and then you take the rubber band and you kind of pull it back. Well, when you let go, it's not going to just gently settle in at even. It's going to overshoot almost as far in the other direction as it is now. And you look at how high that is, even higher than the dot-com bubble. If this thing were to snap back in the other direction, you're looking at a ratio of, in your chart labeled 20 or below 20 or something. I don't know what that translates to in terms of S&P price, but
it depends on what bonds do. It's a relative relationship, but yeah, I mean, it's pretty scary stuff, isn't it? And we had the dot-com was 100 down to 20, so which means that if you're on the other side of that, if at the top of the dot-com bubble you bought bonds, you actually might have made a little bit of money in dollar terms. You actually certainly did pretty well in gold over that 3-year period. But I guess
that's right.
I guess the point is that in an environment like this, the need for alternative assets, we know bonds are going down for political reasons, as you say, and gold's an alternative. So we'll leave it there and move on to other things. I want to get to the gold models. So US CPI yesterday is the monthly number, breaking it down, just to talk you through it very quickly. I mean, energy down for the 2nd month running. Food, not too big a problem, but services, which basically means wages, are more robust. People want a pay rise, and the inflation is not going to go away quickly. I mean, there are different kinds of inflation. For example, if your currency is falling, like in Turkey, aggressively, then that's a source of inflation because imported goods are a problem. If you look at slightly higher inflation in the UK or EU compared to the US, with a weaker exchange rate, that would tie in. Switzerland's had a strong exchange rate, and they've got lower inflation as a result. So you get that kind of FX related stuff. You get the crisis related stuff with confidence, which is more Turkey related. And I guess there are cyclical pressures like supply chain, which you were talking about earlier with natural gas, which is not monetary. I mean, do you have any thoughts on the current direction of inflation, other than it's just going to be volatile and, not go as far as, not going to go back to 2 anytime soon?
No, I don't think it's going back to 2. Quickly. One thing we're starting to see in the U.S. now, and I imagine, although I don't follow it as closely in the rest of the world as well, politicians reacting to the problems in the supply chain and the problems with production and other things by passing more stupid laws. And every one of these laws, distorts the market in some way that you can predict some of the, let's say, first order effects. Very hard to predict the second follow-on effects. So in the U.S., one of the things that some politicians are proposing, including Biden, so I guess this is a leftist policy, and to explain my remarks, sometimes it's hard to tell whether it's the right or the left proposing some of these stupid things. I think it's the left in the U.S. proposing a law to prohibit export of energy, oil and natural gas. There's this jingoistic, well, screw the Europeans, they've made their own mess, let them stew in it or whatever. Plus, hey, energy is so expensive, let's keep American oil for Americans. And what they never seem to think about is, what is that going to do to investment in the oil and gas sector? Well, obviously, it's going to be a downward pressure on CapEx. Why would anybody invest in something that you're not allowed to bring it to market? The people that are putting billions of dollars at risk understand something that the politicians don't understand, which is that there's a cycle here. When the cycle turns, the law will probably remain on the books. And now you won't be able to export to a market when you really need it, and prices are lower. So you'll get reduced production. And so that reduction in supply is then going to feed back into CPI, of course. And since oil is used in the manufacture of everything, including food, then you'll see a higher CPI number, assuming they pass that stupid law. There's now about to be a rail strike in the US. I don't know how, all these things, it's like you've tipped a domino. The dominoes are now in the process of going all the way down. And until they sort of reach the end and we get to some new pseudo equilibrium, every one of these things is, market distortive, hampering or dampening production, reducing supply, putting upward pressure on prices. And then at the same time, governments in the UK and the US are saying, okay, well, all these people that can't afford all these goods and services that they used to be able to afford, let's dole out free money and call it Inflation Reduction Act. So doling out free money to consumers to say, go buy consumer goods, obviously going to push up consumer prices. So where's the end of this? I don't know. So, not next month, that's for sure.
It's not going to come back to 2% anytime soon. So look, here is the interpretation of what the bond market thinks, and this is kind of technical if you're not a sort of bond market person. But the black line is what you read about in the papers. That is what people are telling you inflation was over the last year, 8.3%, down a little bit from a couple of months ago. Now, the bond market, using various things, mainly inflation-linked bonds as pricing, is looking at the other lines. And so the red line is saying over the next 2 years, the bond market thinks inflation will be on average 3%. Over the next 5 years, 2.9, over 30 years, 2.5. And this is the beginning of where we're going with my model. So I'm going to show you my model, and then you're going to show me yours. Do you fancy a game of I show you mine, you show me yours, Keith?
Sounds good.
We'll start with this. And this is the big conundrum, because we have seen a little bit of strength in the gold price in the last couple of years, just not very much. And there was a lot of strength up until the middle of 2020, but then after that, less so. But it's this whole idea of the bond market does not accept that inflation is baked in and it's going to stay. It thinks it's between 2.5% and 3% for the next 2 to 30 years, which is bizarre. And that is the thing that's confusing us. So, I heard that on a Bitcoin panel, people are saying Bitcoin's not an inflation hedge, it's failed this year. Well, look, inflation, according to the market, has been going down. So, ever since April, Bitcoin's been collapsing, and that coincides with falling inflation expectations. The same is true for anything that claims to be an inflation hedge. So according to the bond market, inflation is falling. According to the newspapers, inflation is rising. This is one of those things. Look, we're going to move on because I want to get to your model. Yeah, but first we've got to cover mine. And this is the last 20 years, ever since TIPS began, 1998, where we've got the data. These, I think, are the three most important things in the world to value gold. We've got the 20. So why 20 years? Why are we talking about 20 years? Volatility. So the volatility of gold historically is about 18% a year, a bit less at the moment. But historically, it's about 18. 30-year bonds, 25 to 30%. 10-year bonds, 9-10%. Nice mummy bear in the middle. 18% is about a duration match. So I came with this idea of some years ago of trying to model gold as a bond. I said, well, in the case of an inflation-linked bond, it's got zero coupon, it's got no credit risk, and it's got a 20-year duration on the volatility match, and it's issued by God. And the three things that make those, the three components to that model that are important. Firstly is the history of inflation. Whatever destruction of money, whatever destruction of purchasing power in the past is an input. So if the dollar used to buy 10 times more than it currently did, then you get compensated for that by owning gold, not just in dollars, but any currency around the world, Turkey or wherever. And the second component is the real interest rate, which is talked about a lot. And that the argument there is really simple. If you're standing outside your bank and inflation is 5 and interest rates are 10, then it's pretty attractive to go in the bank and make a deposit. But if it's the other way around, inflation is 10 and deposit and the interest is 5, then actually you'd rather own gold, right? And so the idea of real interest rate really is just that simple trade-off between those two things. And the final point, which is a bit more controversial, is the break-even. So the forward expectation of inflation, that blue line. That's a very, very powerful line. And if that starts going up, then that really starts to put gold on above and beyond the fall in real rates. So to remind you, real rates are the 20-year yield less the 20-year expected inflation rate, and that number has been going up. That the real rate is the red line, and it's been going up pretty aggressively, more aggressively than any time in the last 20 years. So a little surprised that asset prices have not been doing too well. And we're going to go zoom in shorter term and look at the same chart 2 years. And funnily enough, that line that gold's priced off has gone up 2%. So that's been a headwind for gold, a bit of a problem. And people said, where's gold in this whole inflationary era? Well, the real rate has gone up a lot, which is a negative. The inflation, which is a positive, the blue line, that hasn't gone up much. It's actually come down a bit. And then the bond yield's gone up. So the only positive we've had for the gold price recently has been actual inflation, that 9% that we banked over the last year, or 8.2% over the last year, which I think is about 16 in total since the COVID crash. Yeah, so that's the money baked in, which is pretty interesting. And then we're about to get to Keith's model, but we're going to do mine first. And that's it. The black line is the fair value of gold, according to my thesis, which is publicly available on our website, as is this model. So we've had this overvalued gold in 2020. The rally in 19 and 20 before that were totally justified. Gold shrugged off the opportunity to go above 2000 in 2021, probably because there was a crazy equity bull market and there are more interesting things to do. And to what you were saying earlier, the stock market just got expensive in gold terms, or very expensive in gold terms. Gold hasn't slumped this year as much as bonds because it started the year cheap. It's gone down a bit, not very much, but the fundamental underpin has gone down quite a lot, down to the 1550 level on my thesis. And your thesis is going to say the opposite. Your thesis is going to say that gold's actually a little bit more underpinned, isn't it? But we'll just get to that. So 2 more slides, Keith, then we're going to go to you. So that's the premium, my discount premium over the last 10 years. Discount premium is shown in black. And so in 2020, we went to a very high premium of 25. That spike is probably nonsense data from TIPS prices. But the interesting correlation here is the red line. That's the flows. So that is the amount, the rate of change of money going in and out of the ETFs, the gold ETFs. So big.
If I can just chime in for one minor point, that red line would suggest that unless we're looking at a 2013 level event, that those flows could be bottoming and reversing, and if so, that would tend to be bullish the price of gold.
Absolutely. It's hard to imagine that they're not going to bottom because, you know, basically all the gold that people bought in 2020, thinking the end of the world, they've now sold. So all the dumb people bought gold in 2020 and they've lost money and they've now sold it. Why would you sell gold in 2022? It's the most bizarre thing. You know, you've got headline inflation all over the place, the world going to hell in a handbasket. It just seems strange. But, you know, institutional investors are lightly priced. And then we're about to go to you, Keith. I did promise that. I wanted to fly through, try and keep Keith on silent for 3 minutes whilst I get through my stuff. That's the 20-year gold fair value model. All I want to say there, Keith, is I think that gold was really undervalued up until 2005. It's easy to understand why gold was undervalued in 1999. That's kind of obvious. No one would disagree with that. But, you know, gold goes up a bit to 2005, but actually should have gone up a little bit faster, but gets to fair value in around 2008, 9, 10 era. And it's been trading pretty closely to this. And I just see that difference as a discount premium. You know, basically what it's saying is that gold, past, present, and future, conversations for the loss of purchasing power of money. That's what the model does.
Right.
Discount premium. Over to you, Keith. Come on, show me yours.
So our model tends to track the price probably a little closer than yours. And so given the price of gold is so big and the spread between these is often so small, you don't really see a lot of resolution, you know, for those early years. At the very end, on the right edge of the chart, you can see that what we calculate as a fundamental price is above the market price, not by a huge amount, $100.
Sorry, Keith. Can I just show you the 2 slides you're going to get in a sec, just so you can then you've got these. Got it?
I'm sorry. What was the? Okay, yeah. So we have the same thing. We have the discount,
and you've got that. We didn't have time to show you. So just tell me which one you want to tell your story.
Go to the basis co-basis one, because that's really the fundamental of the model, if I dare say so. So you took that as of.
That's a 20-year chart.
You took that as of yesterday. Okay.
Yeah.
So we are looking at kind of the microstructure of the futures market and how it interplays with the spot market. And the whole theory is based on this idea that gold, like any commodity, is warehousable. And when I say warehouse, I don't just mean, okay, someone's sticking in a vault. Yeah, of course, everything's in a vault. But the idea that there's a warehouseman who is providing market coordination. So think of a good like wheat, for example. Most people probably never really think about wheat is basically in the northern hemisphere. There's one harvest, but wheat is consumed evenly throughout the year. How do you coordinate all those different economic actors? Because you have farmers, you obviously have somebody who operates a silo, you have bakers and brewers and everybody else who uses wheat. And the futures market provides that coordination. So the bakers buy, let's say a little bit in the futures contract every month all the way out. The farmers obviously have to dump it. When the harvest happens, there's very little leeway there. And it's the warehouseman who is the arbitrager between the two. So the warehouseman is buying spot on the wheat market, that would be at the time of harvest, and simultaneously, so he's not buying this and then later hoping the price goes up, simultaneously buying spot and selling forward, and then pocketing a spread, which we call we annualize that as a percentage return, so you can compare it to interest rates and locking in that spread, and then meanwhile storing the good in the grain elevator, or in the case of gold, in the vault. So think about this for a minute now. Suppose you go to one of those farming towns that has the silos. I don't know when the wheat harvest would be in the UK, but I'm going to guess it's August, maybe September, I don't know. Suppose you show up in one of those farming towns a week before the harvest, and all of the grain silos are basically empty. And you say, I would like to buy, and you drive up in a grain truck, I'd like to buy a truck full of wheat. Well, nobody has any. So you say, well, I want to buy it right now, cash on the barrelhead. How much? Well, somebody might say, $20 a bushel or something. And what if you want to pay that, then they're going to have to find some wheat that's probably headed off to a bakery, and then basically buy it back. That bakery is going to make more money to give up their wheat supply than they would have made by baking it into bread. That truck will turn around, come back, and by the afternoon offload into your truck. But if you were willing to buy a September future, instead of paying $20, you might pay $7 or whatever the price of wheat is in the market nowadays. So that difference, the fact that spot is higher than futures, means that there's a scarcity of the good. There's an arbitrage available in the market. You could simultaneously sell spot wheat and buy forward and make a profit, except there's only one condition. You actually have to have the wheat in order to take that trade. And if you don't have the wheat, you can't take the trade. So in all normal commodities, this is a good indication of what's available versus what's been consumed. In the case of gold, gold is not consumed, of course. Most of the gold ever mined in human history is still in somebody's hands. So it's a measure not of scarcity of gold as such, but scarcity of gold to the market. When there's a backwardation, which we have not had in gold recently, we have had it in silver recently, last week, for example. But in gold, we have not had that. So anyways, we're measuring that basis, that spread of futures minus spot, and using that as an indicator of relative scarcity. And there are a lot of reasons for that, and I've written tons and tons on why this theory is valid and why it makes sense. But essentially, think of a high basis and a rising basis as an increasing incentive for the warehouseman to carry gold that is simultaneously buy spot and sell forward, which means the marginal buyer of gold is the warehouseman to put it in the warehouse, which is building up kind of an imbalance. And then eventually things will flip, and then the marginal supply of gold will be coming out of the warehouse, which is definitely not bullish while that process is occurring. So we're measuring the basis, which is future minus spot. We're measuring the co-basis, which is spot minus future. And that's our indicator. So you can see it here in gold. And now there's an interest rate component to it. To be the warehouseman, you have to borrow dollars. Traditionally, that was LIBOR. Buy spot, sell forward, pocket a difference, and you have to pay the interest cost. So as the interest rate is rising, one should expect a rising basis. And so what our fundamental model is trying to do is it's trying to say, okay, you have buyers of metal and sellers of metal. We'll call those the fundamental buyers and sellers. You have speculators using leverage in the futures market. And because they're using leverage, they can have an outsized effect on the price. What if we were to somehow model backing out the effects of the speculators and say, at what price would metal be trading if the speculators were in a net neutral position right now? And so taking into account the basis and the interest rate, that's what our model does. So it's not a long-term predictor. It's not saying that we think macro is going in this direction versus that direction. It's just simply saying, if you backed out the speculators, this is approximately the price that metal would be changing hands today. And if you look at, so go into the shorter term fundamental chart, if you would.
I've only got the one. Sorry, I'm not.
Yeah, that one.
Yeah, fine.
Yeah, that one's 3 years. Even on that one, you can see that there's an over and an under. And if you look at the first one, that was the 20-year one. Let's go back to the other one for a minute.
I want you to talk me through that one. So why you think that there's been several discounts, a premium at the peak in 11 briefly, and then a big premium in 2020. By the way, our models agree, by the way, but for different reasons.
Yeah, I was going to say, we're coming at it from a completely different angle. There's a lot of similarities. If you look at the graphs, there are a lot of times when they're the same, and then right now we happen to be at that moment where we differ. But anyways, the point of this chart, or the longer term one, is you can see there's times when our model says the price should be higher. There's times when our model says the price should be lower. And by the way, when there's a disparity, that disparity can be resolved. It always is resolved. This is definitely a mean reverting chart, for sure. That disparity can be resolved either by the market price moving to where the fundamental says it should be, or the fundamentals could deteriorate. In other words, sometimes, not always, and maybe not even the majority of the time, sometimes those pesky speculators are right, that they actually have a thesis that price should change significantly. They position themselves accordingly, and instead of getting flushed out, they actually are right. The price goes where they think it should, and then you get a resolution that way. So the fundamentals could deteriorate further, and then if they do so, then your model could be borne out, and our model would eventually show the fundamental price coming down to match. What did your model say? 1550, something like that. 1546, I think. That is a possible resolution. So this is not per se a price predictor, and certainly not a long-term one. It's just simply saying how much tension, if you have these two pins and you have the rubber band, which direction is the rubber band stretched, and by how far, how much tension is on it at this moment. And right now we kind of have a moderate amount. We have $100 distortion in.
So this slide, I mean, look, our two models are completely different. My inputs are inflation and interest rates only. Yours are the gold price, and you're stripping out what you identify as the speculative factors around the curve and so forth, and lease rates and GOFO rates and that kind of stuff, right?
Right.
Where the reason my model, and gold could be right and my model could be wrong. Why? And gold's always right. But why is my model temporarily wrong, despite generally being quite accurate in estimating bare value? It's because of this. It's because the bond market, mine's priced off the bond market, and the bond market genuinely is in cloud cuckoo land. The bond market thinks inflation's between 2.5 and 3 of the next 2 to 30 years. It's just very unlikely, isn't it? So any pickup in that, any change of thinking there, and then my fair value goes straight up. I mean, don't underestimate how quickly it can happen. Hey, look, brilliant. We're 40 minutes in. I just want to just have a bit of fun at the end and do a bit of Bitcoin and bold, if you don't mind. Now, this is my macro picture that I came up with 15 years ago, I think. The gold model is about 10, 11 years ago, this thing, pre-08 anyway. And so in an inflationary environment, you want hard assets, obviously, gold and Bitcoin. So Bitcoin debates whether it's hard or not, but there's a cap of supply. And then you want financial assets when inflation's low, bonds and equities will do. And then when the world's going well and everyone's happy, we want to own risk on assets, Bitcoin and equities. And when the world's going to hell, we want to own gold and bonds. Simple thesis. Now, what do you think of that?
Yeah, obviously, in a high inflation environment, definitely don't want to own bonds. Gold's a hell of a lot better. Yeah, it's an interesting model. I mean, the questions I would have would be around Bitcoin, and could the changes in the intrinsic to Bitcoin be greater than the changes in the macro environment? So if you plot, month by month, you end up with one of those swirl plots, right? If you look at day by day or month by month where the economy is, right, it's going to swirl around this, the 4 quadrants, and that's giving you some change into asset allocation. But Bitcoin is potentially subject to greater intrinsic changes, and so there's a question mark there. But otherwise, risk on in a low inflation environment, obviously equities is a great place to be. It was a great place to be from 81, to 2001, right? And then after the crisis, recovered again, until 2008.
And the justification here is this is long duration assets, right? So over here we want long duration, right?
Right.
So that I've already said that's 20 years. That could be even longer if you like. And then here we've got kind of growth stocks. So this, you know, within equities, we can split up equities. We can put high quality equities here. We can put Procter and Gamble here, and Unilever and Nestle. Here we can put the growth stocks and the REITs and the normal equities. Here we can put the commodity stocks, and we can put the banks and the insurance companies, and heavy industry would also go up here.
I'm curious if you've done a chart comparing Bitcoin to the gold miners.
Yeah, I've got that. I've got that in the pack, Keith. We'll come to that. So
cool.
what we did at ByteTree, we said, okay, look, 60-40 portfolio down here. Everyone loves bonds and equities. It's how the world's financial system works for savings. And we put gold and Bitcoin together. But we reckon that, you know, gold's really calm, and we love gold and have done for years. And Bitcoin's really interesting, but it's really crazy. So you don't need much Bitcoin. So there's a kind of this whole idea of a risk-adjusted basket. So our basket is basically, without boring you on the math, it's on our website if you want to see it, inverse volatility. You end up with 80% in gold and 20% in Bitcoin, right? And I'll show you the wonders of this extraordinary index. So everyone will tell you that, so this red line is the forward-looking expectation for inflation over the next 10 years for US CPI. And here's our bold index. And everyone says that gold's not a reasonable inflation hedge and Bitcoin's failed as inflation hedge. Put them together on a risk-adjusted basis, and miraculously, they sort of move together. You know, whenever inflation starts to perk up, gold perks up, and when it goes down, gold goes down. And it's just a funny old thing. And you know, the problem with gold in a portfolio, I mean, obviously it does its job brilliantly, but gold alone, you know, it goes up when real rates are falling, inflation's rising, all these things, but then it goes to sleep for 3 years, and everyone starts complaining, saying, well, why hasn't gold gone up for 2 years, 3 years? I mean, after 2011, you had to wait 10 years. After 2013, you had to wait 5 years. All of these things. Now I go, fine, that's what you do. You put 8% gold in a portfolio, and that's it. You just leave it there, right? But what you can do is put a tiny bit of Bitcoin next to it, and you get this extraordinary behavior. But since you asked the question, that is bold relative to gold in gold, relative to silver in silver, and relative to gold mines in red. All rebased to 100 last 5 years. It's remarkable, isn't it? Look, is Keith Weiner silent? This is a mark this moment. Can we mark this moment? And then we're going to go. I'm going to keep showing off because whilst we're running. So we've got in black line the bold index against the S&P 500. And then again, you know, what we saw it earlier, do you remember, with Turkey and all the gold price in Turkish lira, and then all the others ganging up. So we've got all the world stock markets, UK, Japan, Europe, emerging markets, all ganging up, very tight. US, very different this cycle, not like 2000, 2007, it was the other way around. So, you know, but nonetheless, there's not a single one that's below 100. This is bold relative to these markets. Total return, including dividends. No cheating here. And then finally, to equity factors. This is a bit more complex for the people who don't follow this sort of thing. But you know, surely most people have heard of high quality stocks and value stocks and calm stocks, minimum volatility, momentum stocks, small stocks. Again, it beats the lot. So you just got this remarkable thing, you know. And I know you hate Bitcoin, and I'm trying to say to you, Keith, you know, hate it a bit less, because I know that gold's superior. I know gold's the monetary asset. Gold obviously is the winner. You'd have to be quite thick to think that Bitcoin's going to overtake gold. But it's not the point. It's like an exciting alternative liquid asset. The way I say it is that gold's the most liquid alternative asset in the world, $145 billion a day, and Bitcoin's the second most liquid alternative asset in the world, which is actually more liquid than silver these days. And that's pretty interesting. And then you know, we'll go back to chat, but I just want to show you one last slide. And this is the volatility of the bold index in blue, which is below Nestle, Unilever, Microsoft, and a long way below the popular oil and gas exploration stocks, which people can't buy enough of at the moment. So, you know, it's like this, you know, remarkably strong concept. Diversifying two completely different assets. I love Bitcoin because it's the opposite of gold, not because it's trying to be gold. You know, when this market turns, Bitcoin's going to go straight up, far faster than NASDAQ. We just know, we see it every day. Whenever there's a strong day, Bitcoin's up 8, Nasdaq's up 3, 4.
That's an interesting comment. You like gold, I like Bitcoin, not because it's the same as gold, because it's the opposite.
Yeah.
That's not usually what the pro-Bitcoin books say to me.
Well, I think the pro-Bitcoin folks, and I think some of them are a bit confused. I think some of them drank the Kool-Aid. You know, just because something's interesting doesn't mean it has to take over the whole world. You know, I mean,
Right.
and so you know, I saw blockchain in 2012 and thought it was ridiculous, and came back in 2013 and got quite excited and built ByteTree. And you know, I really like it, and I think it's fascinating. Ethereum is, you know, solving a problem today as it goes, the merge happens, and 99.9% less electricity consumption. Fine, you're no longer an alternative asset. You're now part of the club. You're now going to join the Nasdaq. Fine, that's okay. But it's still interesting, but for different reasons to what it was yesterday, because now it's no longer an alternative asset. And the thing about alternatives is there are very few liquid ones, right? I mean, you can have art and stamps and all these things, but there are very few liquid alternative assets, and gold and Bitcoin are up there. And as a multi-asset portfolio manager by trade, that's what I find fascinating about them. That it's the fact they're different from all the other stuff. You know, yeah, there's the S&P, there's Japan, there's the 10-year. Fine, show me something that's completely different. I'm trying to build a portfolio.
Right. No, that makes sense. I mean, the philosophy of that totally makes sense.
Yeah. Where do I, Keith, where do I send the check?
What?
Where do I send the check?
Where do you send the check?
For your last comment. So look, Keith, we're going to go shortly, but I want you to tell us through, there's only one thing that people hate about gold in the institutional circles. You know, the central banks love gold, they buy it. The sovereign wealth funds buy it. The family offices buy it. The individual buys it. The institutional investor does not buy gold because it doesn't pay a yield. How would you solve that problem, Keith?
Yeah, I was going to say, so I should have sent you the charts so we can put it in the deck, but we've taken, you know, old research that most of the big banks, private wealth groups have done over the years, which is you take a standard portfolio, 60% equities, 40% bonds, and put a little slug of 4% gold in it. And what does that do over, you know, long periods of time? Well, slightly better returns, not that much to be excited about, but reduced volatility, smaller drawdowns, better Sharpe ratio. Okay, that makes sense. But then you look at it and say they've cheated. And you mentioned that, you know, what are the dividends included in your competition? And you said, yes, we're not cheating, we included the dividends for the S&P. Well, in gold, cheating is you don't include the storage costs. So if you put in 50 bips a year for storage cost and then rerun that model, then you see that the scenario gets a bit more sour, and you understand exactly why the institutions, you know, don't particularly care for gold too much. So we said, okay, what if instead of a carry cost, you earned interest on it, and then you rerun the scenario, and you know, the gold line is completely taking off relative to over a period of decades, completely taking off relative to the other lines, and even better volatility, even smaller drawdowns, even better Sharpe ratio. So anyway, we have a white paper for any investors that are interested in that. So we pay interest on gold. That's what we do. We are somewhere between an asset manager, and we can't use the word bank. We're not regulated as a bank, no banking license. But conceptually, you know, people bring us their gold, and you know, we find opportunities to put it to work and get a return. So we have two programs that are separate and distinct that achieve the same end, but by different paths. One is leasing gold. So I think every bullion dealer, every jeweler, every refiner, every recycler of e-waste, there's a lot of different verticals that have gold inventory or gold work in progress. And those are financed. So for them, the conventional finance model is they borrow dollars, you know, pay for the inventory, and now they have a mismatch between the liability and the asset, liability being dollars, asset being gold. So then they have to hedge. And a lot of people, you know, just wave their hand and say, oh, well, you know, just hedge. But it's not just. Hedging is kind of a big deal, and there's moving parts and complexity and costs and risks and liquidity challenges and other things. So what we do is we lease them the gold. It is not on their balance sheet, which protects the investor, protects them. They don't have exposure to the volatility anymore. They get the financing they need, and the investor who already chose to own gold and take the price exposure of gold, is offloading that risk from the business and getting paid an interest rate for their troubles. A lease is a very secured instrument. You can never say there's no risk, but with insurance and proper diligence and other things, it's the lowest risk that we know how to do anyways. And the interest rate on those things is paying 2 to 3% net to the investor per annum in gold. So if you give me 100 ounces of gold, at the end of the year, I give you 102 or 103 ounces of gold back. And then whatever the price of gold may be, you get that gain or loss as well. But the interest rate is certainly a kicker that mitigates the downside. You know, if gold goes down 2% and you got 2% interest, you're pretty close to even. And then obviously an enhancer on the upside, if gold goes up 10% and you got 2% interest, you're even better off. We also have a lending program. We call it gold bonds. We issued the first gold bond that we can find or aware of since 1933, when President Roosevelt in the US, but the whole world had been either off the gold standard by 1933 or moving off. That is lending to companies that have not a gold inventory, but gold income. And so think of mining companies, for example. We did our first bond was to a company in Australia, which paid 13% interest. That was successful. The bond matured. Everybody got their principal back plus the 13% interest. Working on one right now at an even higher interest rate. So to borrow gold, you don't need gold inventory. You need a gold income with which to amortize the debt. So a mining company literally has a gold income. That's what they pull out of the ground. If they borrow in dollars, again, it creates that mismatch. The banks who lend to them force them to hedge, creating other problems. And so we're solving a problem for the borrower. We're solving a problem for the saver who has the gold. We think that this is how the gold standard re-emerges, not by lobbying governments for a great gold law, but in the free market, by people expressing a preference that it's better to save in gold than in paper currencies. And if you're saving in gold, it's better to get a return than to pay for storage. And so that's our proposition. That's Monetary Metals. Monetary-metals.com is our website. And I don't know what else to say at this high level.
Well, Keith, thank you very much. And I think we're just going to give people a very quick chance to throw in a question if there is one. And I think the whole idea of gold with a yield is fascinating, because basically, if you could do, gold +3, then you wouldn't really be that interested in anything else, really, would you? And it's actually, you have to take quite a lot of monetary risk to do a good job. Obviously, talking about a wealth preservation portfolio, not a get-rich-quick portfolio, which is what gold's all about: staying rich, not getting rich. But I just think it has a miraculous role in portfolio construction, and it baffles me why it's not more popular. I think it's just because alternative assets are just not held by professional investors anymore, and it's all part of the lie, because we used to have a thing called a balanced portfolio. A balanced portfolio was bonds and equities. The 60-40 is a balanced portfolio, and that was fine. And then in my era, between dot-com crash and 2008. We people like me started to run multi-asset portfolios, proper multi-asset portfolios, embracing lots of weird things, and commodities in particular, gold at the heart of all that. And what happened after 2008 was the balanced portfolio got rebranded the multi-asset portfolio. Everyone's a multi-asset investor, yet they're just balanced investors. They struggle to find anything beyond bond and equities in their portfolios. And so that, gold went off the list again. But they just stole the idea. They said, "Oh, we're multi-asset," because they call emerging markets a different asset class. They call European equities a different asset class. They call inflation-linked bonds a different asset class. Yeah, but these are just equities in old world speak, and they're just bonds in old world speak. So I think the balanced portfolio is thriving. Everyone's running one, but the multi-asset portfolio, everyone's taken the name, but they're not doing it, because if they did, then gold investment would be much higher than it was 10 years ago, and it isn't.
Yeah, absolutely. This, it reminds me of something Warren Buffett said about, hedge funds, which once upon a time were truly hedged, neither long nor short, right? And then over time, the smart thing to do was just essentially leverage, long. And he was derisive, and he said people call hedge funds a different asset class. No, actually, they're a different compensation model.
Compensation model, yeah.
Yeah, for the asset manager.
Yeah. They're a compensation strategy. Was that Munger? Whoever it was. Anyway.
Yeah, either Warren Buffett or Charlie Munger said that.
So look, Keith, I thank you. We've been meaning to do this for ages, and I know you're a Bitcoin skeptic and all that, but I think that I hope you can find some middle ground, just to sort of treat it as another thing that's out there. And I think people, you're kind of got a bit of you've got a bit of Peter Schiff about you, haven't you? Where people sort of not quite the same way, but people attack you as someone who needs to understand Bitcoin, which of course you don't. You fully understand it, but it's obvious that the central banks of the world are not going to start buying Bitcoin anytime soon. But that doesn't mean it's worthless, and the fact that they don't doesn't mean they're stupid. You know what I mean? It's there's middle ground here. I just see the digital assets as inevitable, as something that can only grow over the long term, and something that's interesting and out there. And why wouldn't computers want to exchange value between each other? But that's really got nothing to do with gold whatsoever. The only thing that Bitcoin and gold have in common is limited supply. It ends there.
Yeah, to qualify my remarks about Bitcoin or any of these things, if one's looking at essentially trading strategy, then that's a whole different. My writing tends to try to focus not just on economics but monetary science, and looking at this. And the proposition is that Bitcoin is money, and I've responded by saying it isn't. You're saying, okay, if you're building a portfolio, what does this do to the portfolio? And you've obviously done the math. And you said, okay, this does something very interesting if you had the right balance. And as I understand it, your fund rebalances as the prices shift around to retain that property, and you run the back test. That totally makes sense. I mean, how could anybody argue with that?
Yeah, it's monthly. We actually don't have some sort of complex, clever algorithm. We ran 100 different tests of lots of different things, actually. But the thing that won over in the end was simplicity, that you can explain to people, because the benefit of being really clever was not sufficiently good. And so just monthly rebalancing, something very simple like that, we believe that there's a 6-7% tailwind per year as a result of rebalancing two uncorrelated volatile assets. One's not volatile, one is, but that sort of abrasiveness as they pass of capturing each way. Now, it's not going to work so well in a year like 2022 when one just goes down, but when there's crisscross between them, which is most of the time, then you really do get that powerful force. And the thing about rebalancing, most people understand the power of rebalancing. It works in bonds, equities. I mean, it works in most things. It doesn't work in things that are correlated necessarily in quite the same way.
Right.
But everyone knows the theory about it because they've read it and studied it in the CFA textbooks. Just no one does it. It's complex, it's costly, it's a burden. It's probably got a tax consequence. There's lots of reasons why you wouldn't do it. There's lots of reasons why you would prefer to outsource it to someone whose job it is to do it. But anyway, enough of that. So look, Keith, I'm going to say thank you very much to you for the third time, and fabulous, and looking forward to seeing you on next trip to London.
Absolutely. I'll give you a ring.
Take care.
Thanks so much for having me.